Crypto Trading Masterclass, From Beginner to Strategic Thinker. Cryptocurrency trading is often presented as fast money, instant profits, and luxury lifestyles. Social media shows screenshots of huge gains, expensive cars, and traders claiming financial freedom in months. But behind every sustainable success story, there is structure, discipline, risk control, and a deep understanding of how markets truly work. This is not gambling. This is not guessing. This is probability, psychology, and strategy. Let's break it down properly. 1. The foundation. What cryptocurrency really is. Cryptocurrency is a digital asset secured by cryptography and built on blockchain technology. A blockchain is essentially a distributed ledger, a public database that records transactions across thousands of computers. This decentralization removes the need for banks or central authorities. Bitcoin was created in 2009 as the first decentralized digital currency. Its goal was simple: peer-to-peer money without intermediaries. But today, crypto is much more than just digital money. It includes smart contract platforms, decentralized finance or DeFi, NFTs, Layer 2 scaling solutions, Web3 applications. Understanding what you trade is critical. If you don't understand the asset, you are simply speculating without structure. 2. Trading versus investing. Two different games. Before entering the market, you must decide who you are. Are you an investor or are you a trader? An investor believes in long-term growth. They analyze fundamentals, technology, adoption, tokenomics, and macro trends. They hold through volatility. A trader focuses on short-term price movements. They use charts, patterns, indicators, and market structure. They aim to capture smaller moves repeatedly. Both approaches work, but mixing them randomly destroys accounts. For example, don't call a bad trade a long-term investment. Don't panic sell a long-term position because of short-term volatility. Clarity creates consistency. 3. Market structure. How price really moves. Price does not move randomly. It moves based on liquidity, supply and demand, and psychology. There are 4 main phases in every market cycle. 1. Accumulation. Smart money buys quietly while the public is scared. 2. Markup. Bull market. Price trends upward. Media attention increases. Retail investors enter. 3. Distribution. Smart money sells into strength. Public euphoria peaks. 4. Markdown. Bear market. Price declines. Fear dominates. Weak hands exit. If you learn to identify these phases, you stop buying at the top and selling at the bottom, which is what most beginners do. 4. Risk management. The real secret. Let's be honest. You can be wrong many times and still be profitable if you manage risk correctly. Professional traders focus on position sizing, risk-to-reward ratio, and capital preservation. A simple rule: never risk more than 1 to 2% of your total capital on a single trade. Why? Because survival is priority number 1. If you lose 50% of your account, you need 100% gain to recover. Large losses are mathematically destructive. Trading is not about being right. It is about managing losses. 5. Technical analysis. Reading the language of price. Charts tell a story. Your job is to learn the language. Support and resistance. Support is a price level where buyers step in. Resistance is where sellers step in. Markets remember key levels. These zones often act as turning points. Trends. There are only 3 market conditions: uptrend, higher highs, higher lows; downtrend, lower highs, lower lows; range, sideways movement. Trend is your friend until it ends. Trading against the trend is possible, but it requires experience and precision. Volume. Volume confirms strength. If price breaks resistance with strong volume, the move is more reliable. Low volume breakouts often fail. Indicators. Indicators don't predict the future. They measure momentum and probability. Common tools include moving averages, RSI, Relative Strength Index, MACD, Bollinger Bands. But remember, indicators lag price. Price action always comes first. 6. Psychology, the invisible enemy. The biggest battle in trading is not against the market, it is against yourself. Emotions that destroy traders: fear, greed, FOMO, fear of missing out, revenge trading, overconfidence. You might have a perfect strategy, but one emotional mistake can erase weeks of progress. Professional traders follow rules. They enter with a plan. They exit with discipline. They accept losses calmly. Losses are part of the business. 7. Building a trading plan. If you don't have a plan, you are gambling. A trading plan includes entry criteria, exit criteria, stop-loss placement, risk percentage, time frame focus, strategy type, scalping, day trading, swing trading. Write it down, follow it strictly. Consistency creates data. Data creates improvement. 8. Timeframes and strategy. Different timeframes require a different mindset. Scalping, minutes. Day trading, intraday. Swing trading, days to weeks. Position trading, weeks to months. Lower timeframes mean more noise and stress. Higher timeframes require more patience. Choose what fits your personality, not what looks exciting. 9. Fundamental factors that move crypto. Crypto is influenced by Bitcoin dominance, global economic conditions, interest rates, regulatory news, ETF approvals, institutional adoption. When liquidity increases globally, risk assets like crypto benefit. Understanding macroeconomics gives you an edge. 10. Common beginner mistakes. Let's be direct. Most beginners overtrade, use too much leverage, follow random signals, trade without stop loss, chase pumps, ignore risk management. Avoiding mistakes is more important than finding perfect trades. 11. Leverage is a double-edged sword. Leverage amplifies gains and losses. Using 10x leverage means a 10% move against you can liquidate your position. Beginners should avoid high leverage completely. Master consistency first, amplify later. 12. The long-term perspective. Crypto markets are volatile, but zoom out. Over years, strong projects grow exponentially. Short-term noise creates opportunity. Long-term vision creates wealth. Some traders combine both: long-term investment portfolio, short-term trading account. Separation prevents emotional conflict. 13. Developing the right mindset. Think like a professional. Focus on process, not profit. Accept uncertainty. Track performance. Improve gradually. Trading is a skill, like playing an instrument or learning a language. It requires repetition and reflection. 14. Journaling and self-analysis. Serious traders journal every trade. Why did I enter? Was the setup valid? Did I follow my rules? What can I improve? This transforms random trading into structured growth. 15. The truth about easy money. There is no secret indicator. There is no magic strategy. There is no guaranteed signal group. There is discipline. There is patience. There is probability. If you treat trading like entertainment, you will pay for the show. If you treat it like a profession, you build skill. 16. Building capital gradually. Start small. Your first goal is not to make $10,000. Your first goal is to prove you can follow rules consistently. Grow your account step by step. Compounding works, but only if you survive long enough. 17. The final perspective, the real opportunity. Crypto is still a young market. Innovation continues. Adoption grows. Volatility creates opportunity. But opportunity without discipline becomes destruction. The difference between amateurs and professionals is not intelligence, it is structure. If you master risk management, emotional control, strategy consistency, long-term thinking, you put yourself ahead of the majority. Final words. Crypto trading can change your financial future, but only if you approach it seriously. Be patient, be disciplined, be strategic. The market rewards preparation, not hope. And remember, it's not about one trade. It's about building a system that works over time.